I've made my career by seeing what others refuse to see, by reading the data while everyone else reads headlines, by trusting numbers over narratives, by betting against consensus when consensus is built on delusion. And when I study the crash of 1929, I don't see some random market accident. I see a case study in willful blindness, a masterclass in how investors ignore every single warning sign because acknowledging reality would mean admitting they're wrong. My name is Michael Burry, and I'm going to show you exactly how the 1929 crash happened, not the sanitized version you learned in school, the real version. The one that shows how markets can scream danger for months while investors cover their ears and keep buying. Because here's what nobody wants to admit. The crash wasn't a surprise. The warnings were everywhere, the data was clear, the smart money saw it coming and positioned accordingly. But the crowd, they ignored every single signal until it was too late. Sound familiar? It should. Because we're watching the exact same pattern play out today. Let me start with something most people don't understand about market crashes. They don't happen suddenly. They're not lightning strikes from a clear sky. Crashes are the inevitable conclusion of processes that build over years. They're mathematical certainties that become obvious in hindsight but are vigorously denied in real time. The 1929 crash was no different. Throughout the 1920s, stock prices had been climbing at rates that defied economic fundamentals. The Dow Jones Industrial Average increased by over 400% from 1921 to 1929. 400% in 8 years. Now, to a rational analyst, that should immediately raise questions. What changed so dramatically in the economy to justify such price increases? Had productivity quadrupled? Had corporate earnings grown proportionally? The answer was no. Stock prices were rising far faster than the underlying businesses could possibly support. But when I look at the data from that period, what strikes me most is not that prices rose, it's that every warning sign was dismissed with the same rationalizations we hear today. This time is different. New technology changes everything. The old rules don't apply. Anyone warning of danger is just bitter. They're missing out. I've heard all these arguments before. I heard them before the dot-com crash. I heard them before the housing crisis. And I'm hearing them again now. Let me walk you through the specific warnings that were flashing red throughout 1929. Each one was visible to anyone willing to look. Each one was ignored by the crowd. First, margin debt. By 1929, nearly 40% of all stock purchases were made with borrowed money. Think about that. 4 out of every $10 invested in stocks wasn't actually investor money, it was loans. When I see leverage ratios like that, I immediately understand the fragility of the system because leverage amplifies everything. It amplifies gains on the way up, which makes people feel like geniuses, but it also amplifies losses on the way down, which destroys them. The mathematics are simple. If you buy stocks with 50% borrowed money and the market drops 20%, you've lost 40% of your actual investment. Your equity is cut in half. Now scale that across an entire market where 40% of purchases are leveraged. What happens when prices start to fall? Investors get margin calls. They're forced to sell to meet those calls. That selling pushes prices lower, which triggers more margin calls, which forces more selling. It becomes a self-reinforcing cycle of destruction. And it's entirely predictable if you understand the structure. But in 1929, investors didn't want to think about downside risk. They were making too much. The warnings about excessive leverage were dismissed as pessimism from people who didn't understand the new era of prosperity. Second warning, valuation metrics. By any historical standard, stocks were absurdly expensive by late 1929. The price-to-earnings ratio of the overall market had climbed to levels that had never been sustained in market history. Companies were trading at 20, 25, even 30 times earnings. Now, I'm a value investor. I look for assets trading below their intrinsic value. When I see entire markets trading at valuations that require perfect conditions to justify, I know something is wrong. Because perfect conditions never materialize. Economies are cyclical, businesses face competition, disruption happens, the future is uncertain. Yet investors in 1929 had priced in permanent prosperity. They had convinced themselves that high valuations were justified because this time truly was different. The data said otherwise, but data doesn't matter when narrative takes over. Third warning, insider selling. Throughout 1929, corporate executives and major shareholders were selling their stock in record quantities. Think about what that means. The people who know these businesses best, who have access to information the public doesn't, were liquidating their positions. They were converting their stock holdings into cash. This is one of the most reliable signals in investing. When insiders sell, pay attention. They might be wrong, but they're making informed decisions based on privileged information. Yet public investors ignored this completely. They kept buying while insiders kept selling. The transfer of wealth from uninformed to informed was happening in plain sight. Fourth warning, credit tightening. The Federal Reserve had been raising interest rates throughout 1929, trying to cool the speculation in stock markets. When I see central banks tightening credit during a leveraged bubble, I know the end game is approaching. Because bubbles require continuous inflows of fresh money. When credit becomes more expensive, those inflows slow down. And when they stop, the bubble pops. The Fed's actions were a clear signal. They were trying to deflate the bubble gradually before it exploded catastrophically. But investors interpreted higher rates as a sign of confidence in the economy rather than concern about speculation. Fifth warning, divergence between stocks and bonds. Throughout the summer and early fall of 1929, bond prices began strengthening even as stocks continued climbing. This is a critical signal that most investors miss. Bonds and stocks usually move in opposite directions based on economic expectations and risk appetite. When stocks are soaring, bonds typically fall as investors abandon safe assets for risky ones. But when bonds start rising while stocks are at all-time highs, it means sophisticated investors are moving to safety. They're preparing for trouble. In 1929, the bond market was flashing a warning that the stock market ignored. Professional investors were quietly repositioning, while retail investors chased the last gains of the bull market. Sixth warning, international capital flows. Foreign investors, particularly British and European institutions, had been steadily reducing their exposure to American stocks throughout 1929. International investors often see problems before domestic ones because they have emotional distance from local narratives. They're not caught up in the patriotic fervor or cultural momentum that blinds local investors. By October 1929, European money was flowing out of American markets at an accelerating rate. This should have been a massive red flag. Instead, it was barely noticed. Seventh warning, trading volume patterns. In the weeks leading up to the crash, trading volume had spiked to unprecedented levels. Most investors interpreted this as enthusiasm, more people wanting to participate in the boom. But when I analyze volume patterns, I look for distribution versus accumulation. High volume during price increases can mean institutional investors are selling to retail investors. The professionals are distributing their holdings while the amateurs are accumulating. That's exactly what was happening in October 1929. The smart money was exiting while the dumb money was entering. Eighth warning, leverage in investment trusts. The investment trusts of the 1920s were essentially the mutual funds of that era, but they operated with leverage that would be illegal today. These trusts would borrow money to buy stocks, but they wouldn't just buy regular stocks. They would buy shares in other investment trusts that were also leveraged. So you had leverage stacked on leverage, stacked on leverage. A pyramid of debt supporting inflated asset prices. I've seen this pattern before. In the lead up to 2008, we had CDOs of CDOs of CDOs, synthetic structures built on other synthetic structures, leverage compounding until the entire system became unstable. The mathematics of these structures guarantee eventual collapse. It's not a question of if, but when. Yet investors in 1929 convinced themselves that the complexity somehow reduced risk rather than amplifying it. Ninth warning, commodity price weakness. Throughout 1929, commodity prices were falling even as stock prices climbed. Commodities reflect real economic demand. When industrial metals, agricultural products, and energy prices are weakening, it suggests the real economy is slowing down. But stock prices are often driven by sentiment and liquidity rather than fundamentals. They can disconnect from economic reality for extended periods. That divergence between falling commodity prices and rising stock prices was telling anyone who paid attention that the stock market had decoupled from economic fundamentals. 10th warning, margin call increases. As early as mid-October 1929, brokerage houses were reporting increasing numbers of margin calls. This means investors who had borrowed money to buy stocks were already struggling to meet their obligations even before the crash. Prices had been drifting lower, triggering these calls. When I see margin calls increasing during what's supposed to be a bull market, I know the structure is fracturing. The leverage that amplified gains is about to amplify losses. But investors who received these margin calls didn't interpret them as warnings. They borrowed more money or sold other assets to meet the calls and maintain their stock positions. They were doubling down on a losing bet. Now, here's what fascinates me about studying 1929. It's not just that these warnings existed, it's that they were actively discussed and then dismissed. Financial. Newspapers documented insider selling. They reported on margin debt levels. They covered the Fed's rate increases. The information was public. But investors created narratives to explain away each warning. And those narratives always concluded the same way. This time is different. The American economy had entered a new era of permanent prosperity. Technology was changing everything. Radio companies and automobile manufacturers were revolutionizing society. The old rules of valuation didn't apply to this new economy. Sound familiar? I heard identical arguments in 1999 about internet companies. Technology was changing everything. Traditional metrics like earnings didn't matter. We had entered a new paradigm. Then the crash happened and suddenly earnings mattered again. I heard the same arguments in 2006 about housing. Real estate never goes down. Everyone needs a place to live. Subprime borrowers might have poor credit, but they're good for it. Then that bubble popped too. The specific assets change. The technology du jour changes. But the pattern remains constant. Excessive leverage, stretched valuations, warning signs ignored, and narratives that justify the unjustifiable. Let me tell you about some of the specific players who saw what was coming and positioned accordingly, because this is where it gets really interesting. Joseph Kennedy, who would later become one of America's wealthiest men and father to a president, was actively selling throughout 1929. The famous story is that he decided to exit the market after his shoeshine boy started giving him stock tips. But that's too cute. The reality is Kennedy understood leverage. He understood that when everyone is borrowing to buy stocks, when taxi drivers and shoeshine boys are speculating, you're at the top of a bubble. Kennedy didn't just sell, he went short. He bet against the market. And when the crash came, he made a fortune. Bernard Baruch, another legendary investor of that era, had been reducing positions throughout the summer of 1929. Baruch had lived through the panic of 1907. He knew what bubbles look like. He knew the warning signs. Baruch later wrote that he could sense danger in the very air of Wall Street. The conversations, the confidence, the reckless optimism. It all reminded him of previous crashes. So he converted most of his portfolio to cash and government bonds. He was ready when the storm hit. Jesse Livermore was perhaps the most aggressive bear during this period. Livermore was a legendary speculator who had made and lost fortunes multiple times in his career. He understood crowd psychology better than almost anyone. Livermore spent months building enormous short positions throughout 1929. He wasn't avoiding the crash. He was positioning to profit massively from it. When stocks fell, Livermore's shorts paid off spectacularly. He made over $100 million from the crash. In today's money, that would be multiple billions. Now, here's what I want you to understand about these men. They weren't lucky. They weren't inside traders in the illegal sense, though they certainly had better information than retail investors. They were disciplined. They trusted data over narrative. They understood market mechanics and the mathematics of leverage, and they had the courage to act on their analysis even when doing so made them unpopular. That's what separates successful investors from everyone else. Not intelligence, not luck, discipline, and courage. Most investors know what they should do. They can see the warning signs if they look, but they lack the discipline to act on that information when it contradicts what they want to believe. In October 1929, the average investor wanted to believe the boom would continue. They wanted to believe their stocks would keep going up. So they ignored every warning that contradicted that belief. The smart money didn't have that luxury. They dealt in reality, not hope. Let me walk you through the specific mechanics of how the crash unfolded, because this is where you really see the inevitability of it all. On October 24th, 1929, later called Black Thursday, the market opened with heavy selling pressure. Prices immediately gapped lower. This triggered margin calls across the system. Investors who had borrowed money to buy stocks were suddenly receiving calls from their brokers demanding more cash or threatening to liquidate their positions. Those investors had three options. They could add more cash to their accounts, they could sell other assets to raise cash, or they could let their brokers sell their stocks. Most couldn't add cash. They were already fully invested and leveraged, so they had to sell. That selling pushed prices lower, which triggered more margin calls, which forced more selling. By midday, the system was in free fall. The selling became indiscriminate, quality stocks were dumped alongside speculative garbage, nobody cared about fundamentals, they needed cash immediately. A group of major banks stepped in that afternoon, pooling money to buy stocks and stabilize prices. This temporarily halted the decline. Prices recovered somewhat by the close. The media hailed this as proof that the worst was over. The banking intervention showed that institutional support existed. The bull market would resume. But anyone analyzing the actual data could see this was temporary. The margin calls hadn't stopped. They had just been delayed. The leverage in the system hadn't disappeared. It was still there, waiting to unwind. October 28th was worse. The selling resumed with even greater force. The banking coalition that had provided support on Thursday was nowhere to be found. They had realized that fighting the tide was futile. Prices fell sharply throughout the day. Trading volume overwhelmed the systems of that era. The ticker tape that reported prices fell hours behind actual trading. Investors were selling blind, not knowing what prices they were actually getting. The psychological impact was devastating. Investors watched their wealth evaporate in real time. Years of gains disappeared in hours, but the real carnage came on October 29th, Black Tuesday. The market opened with selling pressure that made the previous days look mild. Prices collapsed. Not gradually, not in an orderly way. They simply collapsed. The mechanics of what happened are mathematically simple. The leverage that had amplified gains on the way up was now amplifying losses on the way down. An investor who had bought stocks with 50% margin and watched them fall 50% had lost everything. Their equity was wiped out. Their brokers sold their positions automatically. That forced selling pushed prices lower, which meant more investors crossed the threshold where their equity was gone, which forced more selling. It became a cascade, a chain reaction, an unstoppable force of mathematical inevitability. By the end of Black Tuesday, the Dow Jones Industrial Average had fallen nearly 25% from its peak just weeks earlier. Billions of dollars in wealth had evaporated. But here's what most people don't understand. The October crash was just the beginning. The real destruction came over the following years. The market continued falling throughout 1930, 1931, and 1932. By the bottom, stocks had lost almost 90% of their peak value. 90%. If you had invested $10,000 at the top of the market in September 1929, it was worth $1,000 by the bottom in 1932. And it would take 25 years for the market to recover to its 1929 peak. 25 years. Think about that. An entire generation of investors never recovered. People who were saving for retirement in 1929 were still underwater in 1954. This is what happens when bubbles deflate. The destruction is not just severe, It's generational. Now, why am I telling you all of this? Why does studying a crash from almost 100 years ago matter? Because the patterns repeat. The specific assets change, the technology changes, the narratives change. But the fundamental dynamics of bubbles and crashes remain constant. Excessive leverage, valuations disconnected from fundamentals, warning signs dismissed, narratives that justify the unjustifiable, the belief that this time is different. These patterns appear in every bubble, every single one. I saw them in the dot-com bubble. Companies with no earnings trading at astronomical valuations because the internet was supposedly changing everything. I saw them in the housing bubble. Subprime borrowers getting loans they could never repay because housing prices would supposedly never fall. And I'm seeing them today. Everywhere I look, I see the same warning signs that preceded previous crashes. Margin debt at record levels, valuations at extremes that have never been sustained, retail investors speculating on assets they don't understand, narratives that claim traditional metrics don't matter. The specific warning signs I would point to today are remarkably similar to 1929. We have extreme concentration in a handful of mega-cap technology stocks driving the entire market. When I see that kind of concentration, I know the market is fragile. If those few stocks stumble, the whole structure falls. We have record levels of passive investing through index funds, money flowing into markets without any analysis of value or risk. That creates price-insensitive buying that inflates bubbles. We have retail investors using leverage through options and margin to amplify their bets. The same dynamic that destroyed investors in 1929. We have a generation of investors who have never experienced a real bear market. They think buying the dip always works, that the Fed will always save them, that stocks only go up. These people are about to learn painful lessons. We have bond markets signaling concern while stock markets hit new highs. The same divergence that appeared in 1929, we have insiders selling at elevated levels. CEOs and major shareholders converting stock to cash. The people with the best information are exiting. We have commodity prices showing weakness even as financial assets inflate, suggesting the real economy is slower than stock prices indicate. Every warning sign from 1929 is flashing today. But just like then, investors are dismissing each one with rationalizations. The Fed has our back. Technology is different this time. Interest rates are low, so valuations don't matter. Inflation justifies higher prices. We're in a new paradigm. I've heard it all before. And it always ends the same way. Now, I can't tell you when the crash will come. Nobody can predict exact timing. Markets can remain irrational longer than you can remain solvent, as the saying goes. But I can tell you with certainty that it will come, because the mathematics demand it, because leverage always unwinds, because valuations always revert to historical means, because bubbles always pop. The question isn't whether there will be a crash. The question is whether you'll be positioned to survive it or destroyed by it. Most investors will be destroyed, just like in 1929, because they're ignoring the warnings, they're trusting narratives over data, they're hoping instead of analyzing. The smart money is already positioning. They're reducing risk, building cash positions, looking for asymmetric opportunities that will pay off when the inevitable occurs. I've built my career on seeing what others refuse to see, on trusting data when everyone else trusts hope, on having the courage to act on analysis even when it makes me unpopular. That's how I identified the housing bubble before 2008, not through luck or insider information. Through analysis, through seeing the obvious that everyone was ignoring. The subprime mortgage securities were obviously mispriced. The housing market was obviously in a bubble. The leverage in the system was obviously unsustainable. But nobody wanted to hear it. I was called pessimistic, negative, a permabear who didn't understand the new dynamics of housing finance. Then the crash came, and suddenly I was prescient. But I wasn't prescient. I was just willing to look at reality. The same reality is staring investors in the face today. The warnings are everywhere. The data is clear. The parallels to previous bubbles are obvious. But investors are doing exactly what they did in 1929, exactly what they did in 1999, exactly what they did in 2007. They're ignoring every warning. They're trusting narratives that justify unsustainable valuations. They're convincing themselves that this time is different, and they're going to pay the same price that investors always pay for ignoring reality. The crash of 1929 destroyed a generation of wealth. The investors who survived were the ones who saw the warnings and acted on them, who trusted data over hope, who had the discipline and courage to position against the crowd. History doesn't repeat, but it rhymes. The investors who study these patterns, who understand the mathematics of leverage and bubbles, who have the courage to act on their analysis, those are the ones who survive. Everyone else becomes a cautionary tale, a statistic. Another example of how markets punish the unprepared. The warnings are flashing. The data is clear. The question is whether you're going to pay attention or join the crowd in pretending everything is fine until it's too late.